Over the last 25 years, the federal deficit has steadily increased to a point that calls into question the financial integrity of the United States government. At its current point, the deficit as a percentage of GDP stands at 6%, which is the highest percentage level the U.S. has ever maintained in an expansionary peacetime era. Back in World War II, the deficit briefly peaked at a staggering 25% before quickly rebalancing in the post-war era. During the 2008 financial crisis, the deficit exploded to 10%, and then again to 15% during the COVID pandemic, as falling tax revenues combined with rising federal benefit payouts created the perfect financial storm that eroded the foundation of U.S. fiscal integrity. While these deficit peaks were short-lived, the current trajectory of the deficit is unsustainable and is pointing to financial and economic ruin. The rising deficit has increased the federal debt to its highest level as a percentage of the economy than ever before in the 20th century, even surpassing the peak that was reached in World War II, and it won't stop there. The deficit and rising debt load has started to push up long-term interest rates, increasing borrowing costs drastically for both the U.S. government and its citizens. Since the deficit was financed with newly printed money sitting in bank reserves at the Fed, the federal government has created massive price inflation that spiked in 2022. Although the inflation rates have calmed down since then, the harbinger of what's yet to come will be far worse. The current federal deficit stands at $1.6 trillion as of 2023, where tax revenues have just not been able to keep up with the federal government's exorbitant expenditures. For the purposes of this video, I have broken down the deficit into two pieces. The non-entitlement piece, which makes up 2/3 of the deficit and is funded by income taxes and borrowing. And then there's the entitlement piece, where the other 1/3 is located and is funded by FICA taxes, benefit premiums, as well as federal allocations. Let's first take a look at the entitlement side of the federal budget. The entitlement side is comprised of Social Security and Medicare, where payroll taxes the federal government collects, along with health care premiums for Medicare's Part B and D, are supposed to sustain it. However, starting in 2006, entitlement started to run a budget deficit, and it has only gotten worse as time went on, as changing demographics among the American public has resulted in more beneficiaries drawing on benefits versus American workers able to furnish those expenditures. A deeper look into the composition of the deficit reveals that over 85% of it is caused by Medicare, specifically Medicare Part B and D. That is, Medicare's medical and prescription coverage, which is not funded by payroll taxes at all. Medicare's payroll taxes only fund Part A, which is the hospital insurance portion of Medicare coverage. The skyrocketing cost of healthcare coverage and a reluctance by politicians to jack up the premiums to compensate has resulted in the federal government supplementing the lion's share of Medicare Part B and D expenditures with borrowed money. So that while Social Security's deficit as a whole is salvageable and can be fixed with minor adjustments such as raising the retirement age as longevity of life increases, or applying the Social Security payroll tax to all income brackets and not just the first $168,000 American workers make, the Medicare's budget fiscal deficit is significantly worse. Medicare's payroll tax is already applied to all income brackets, and a further 0.9% tax is already applied to those making over $125,000. For Medicare to be made whole, Medicare's payroll tax will have to be doubled just to keep up with current expenses, which would translate into another 3% increase on payroll taxes among the public. For a wage earner earning $50,000 a year, it would mean another $1,500 would have to be taken out of their paycheck each year for Medicare to sustain itself at its current trajectory. It's either that, or Medicare premiums will have to triple, or Medicare Parts B and D benefits will have to be cut. Looking at the rest of the federal budget, the non-entitlement fiscal deficit began after the bursting of the dot-com bubble and 9/11 in 2001, which plunged tax revenues and forced the federal government to begin borrowing again. From that point forward, a volatile economic environment, along with upward pressure on federal spending levels, widened the deficit to its current point at $1.1 trillion. While spending as a percentage of GDP climbed by 20% from 2000 to 2023, tax revenues as a percentage of GDP fell by 15%. An analysis of the budget finances in 2000 compared to 2023 reveals more of where the problems originated. Federal tax revenue little more than doubled in the 23 years that followed, while government spending more than tripled, which widened the deficit drastically. In particular, welfare spending, Medicaid, and other non-entitlement benefits spent by the federal government increased as a percentage of total non-entitlement spending, which nearly quadrupled in 2023 from its 2000 spending levels as the rest of the sections more or less tripled. Meanwhile, the effective corporate tax rate chopped in half during this time frame, though this was offset by corporate net income doubling in size as a percentage of the economy, which kept revenue increases for corporate taxes in line with the rest of tax revenue sources. This obfuscates the tax revenue that would have come into federal coffers had the effective corporate tax rate been more in line with the rates in the 1980s and 1990s, as corporate profits would have likely not reached the levels as they did with the tax cuts, and thus the corporate income as a percentage of the economy would be smaller. As a result, lower corporate taxes do negatively affect federal fiscal performance, but not as much as progressive proponents might think, where only 15% of the $1.1 trillion deficit is rooted in lower effective corporate tax rates. The other 85% comes from government spending increases beyond tax revenue levels. And of that 85% share, over 50% of that portion comes from increases in welfare, Medicaid, and other government benefits. Interest payments have also started to climb sharply in the post-COVID economy, primarily because of the rising interest rate environment from the massive price inflation over the last couple of years. Post-2008, interest payments remained low, even as deficits started to rise because of the falling interest rate environment provided by the Fed. Now that safeguard is gone, and federal fiscal finances are threatening to go off the rail, especially when we realize that the effective interest rate the federal government is currently paying on its existing debt is lower than the current market yield on government bonds, unlike the situation that was in the 1980s, 1990s, and 2000s. This means that as old government debt is recycled for new government debt, the effective interest rate will be pushed upward, closer to the current market yield, and this will force government interest payments upward. At the current average market yield on government bonds, along with calculating the current federal debt level at $34 trillion, interest payments on the debt would climb to $1.7 trillion, as $34 trillion of debt will be priced at a nearly 4.5% interest rate. This would be tantamount to a $600 billion increase to the U.S. deficit, which we will likely see in the next couple of years. To compound this problem, if the U.S. economy went through another 2008-like crash, the deficit would explode even further, because federal benefits would increase with falling living standards and income along with decreased tax revenues. After the 2008 financial crisis, federal benefit payouts increased by 75%. Translated into 2023 dollars, this would equal another $1.1 trillion of spending that would be added to the deficit. Then there's the decreased tax revenue that must be taken into account. Following the 2008 crash, federal tax revenues declined by 17%, which would equal about $800 billion in less revenue in 2023 income. So when we take into account the full financial impacts of the coming economic environment, from rising interest rates to an economic contraction, increasing spending, and decreasing tax revenues, the federal deficit will likely escalate to over $4 trillion, with 3/4 of that increase coming from an increased government spending and putting the federal deficit at about 15% of GDP, the highest level ever to be recorded outside of a wartime economy, and likely to remain in that elevated state for some time. The economic consequences of such a financial state would be catastrophic to the U.S. economy. The exponential debt increases will further push up interest rates, which will impact Americans' abilities to purchase a home, buy a car, take vacations, or borrow money to start a business. Stock prices will correct downward from the higher interest rates, which will negatively impact Americans' retirement, net worth, and living standards. The rising debt load could also overwhelm the foreign exchange markets, where the U.S. dollar and dollar-denominated debt have enjoyed a premium status of being sought out as a safe investment for foreign capital. The rising deficits would also contribute to an increase in the money supply, as reserves that are supplied at the banks, provided by the Federal Reserve with printed money, will be spent by the U.S. Treasury at ever-increasing rates. Even with the U.S. economy, foreign investors will only tolerate unsound fiscal practices for so long before they sell off their debt holdings, as rising interest rates destroy the market asset value of their debt securities, and the dollar will devalue as a result. This, in turn, will cause a huge jump in commodity prices, gold and silver in terms of U.S. dollars, and will herald the return of rampant consumer price inflation, much like what the United States and many other countries went through after the spending sprees during the COVID pandemic. American living standards will deteriorate drastically at this point, and what has commonly been seen for the past 100 years as the American era will likely come to an end.